Closing entries for a merchandiser are very similar to the closing entries for a service company. The only difference is that we have a few new accounts that we have to close out that we did not have for a service company. As a review, your first closing entry for a service company closed out your revenues and expenses. Revenues have a credit balance, so to close them out we have to debit them. Expenses have a debit balance, so to close them out we have to credit them. And then whatever it takes to make that entry balance goes to our retained earnings account. If we have a net income, then in order to make that entry balance, we're going to need to credit retained earnings, which makes it go up. If we had a net loss, we would find that we have to debit retained earnings instead to make that entry balance. We're going to do the exact same thing for a merchandiser that we did for the service company. The only thing we need to keep in mind here is that when it comes to revenues, the merchandiser's primary revenue is called sales, and when it comes to expenses, the merchandiser has an expense that is unique to them called cost of goods sold. So we're really going to make just the same closing entry that we did for a service company. As we close out my revenues, we need to be sure to include sales, and as we close out my expenses, we need to be sure to include cost of goods sold. Again, whatever it takes to make that entry balance is going to go to the retained earnings account. If it's a net income, you're going to need a credit to that account to make it balance. If it is a net loss, you're going to find yourself debiting retained earnings to make it balance. My second closing entry for a merchandiser is exactly what it was for a service company. We're going to close out dividends. Dividends have a debit balance, so to close them out, we're going to have to credit dividends. My debit goes to retained earnings. This makes retained earnings go down because paying out dividends makes the net worth of my business go down. Let's look at this example. And first off, let's decide what accounts are we going to close out and which ones are we not going to close out. Well, cash is an asset. We don't close out assets. Inventory is an asset. We don't close out inventory because we don't close out assets. We're going to assume the Millennium Falcon is our building. It too is an asset. We don't close out assets. Accumulated depreciation is a contra asset. It goes right along with the asset, so we will not close it out. Accounts payable is a liability. We won't close it out. Common stock, we will not close out either. We're not going to close out retained earnings either. Now, we will use retained earnings in our closing entries. However, we are not going to close out the retained earnings account. The only time we close out the retained earnings account is when we're going out of business, and that's not going to happen this semester. We will close out dividends in our second closing entry. We will close out sales, interest income, because those are my two revenues, so I'll close them out. Then we will close out cost of goods sold and all of these other expenses also. So, we are not going to close out anything from cash down to retained earnings. We will close out dividends, we'll close out my two revenues, and we'll close out all of the other expenses. In my first closing entry, I'm going to close out my two revenues for starters. Revenues have a credit balance. We're going to close them out with a debit them. So I'm going to debit sales, and I'm going to debit interest income to get their balance down to zero. I also need to zero out my expenses. Remember, cost of goods sold is an expense too. Expenses have a debit balance, so we're going to close them out with a credit. So I'm going to credit cost of goods sold and all of these other expenses as well. In order to make this entry balance, this time it's going to require a credit. If you add up the two debits, add up all of those credits, you're going to see that we have more debits than we do credits. And in order to make this entry balance in, I'm going to need a credit, and it's going to my retained earnings account. The amount is going to be the $49 that it takes to make my journal entry balance. We have more revenues than we do expenses in this example, which means we have a net income. Earning a net income makes the net worth of my business go up. Therefore, crediting retained earnings will make the net worth of my business go up also. Closing out dividends. Dividends have a debit balance. We're going to close them out with a credit to dividends, and my debit goes to my retained earnings account.